Imagine the Wall Street whale that's printed billions in dollars by shorting the dollar this year. It's now starting to choke on its own line as the greenback is surging just like a wrecking ball, ready to pulverize the tech giants, send gold and silver crashing, and ignite what could be a crypto Armageddon. And what this is going to do is squeeze billions of gains right into dust. And this isn't a glitch. It's a flip of the biggest trade of the century. And if you're not positioned right, your portfolio could be next. And just like a phoenix rising from the ashes, the dollar screamed to a 2-month high and starting to inflict real pain on the short sellers. And now everyone thinks that if the Fed cuts rates, it's going to send the dollar crashing again. But wait until I show you how the dollar reacts to a weakening labor market. You'll understand why the dollar is back and in a big way. And by the end of the show, I'm going to show you just how to turn this dollar short squeeze into real dollars in your pocket. Because the big dollar short is turning into a pain trade for investors. Again, this has been the biggest trade of the year. Everybody is short the dollar, and they're taking those short positions and turning around, going long tech, long gold, long crypto, long virtually anything else. Now, if you're wondering just how big it is and how much pain this could be, well, the currency markets right now trade about 9.6 trillion. That's right, with a T, a day. And if you think about the short dollar, it's the biggest trade of the year. That means there's potentially trillions of dollars that are short the dollar, and it's all going to come unwound. And again, that's why I'm saying it could send tech, gold, silver, crypto, and a lot of things crashing down, because when you have a bet of this magnitude where money's flowed into other assets, well, as the dollar rallies and those shorts get covered, well, people are going to have to sell to cover them. The world's primary reserve currency is around a 2-month high, even as the U.S. government shutdown drags on, and traders in Asia and Europe say hedge funds are adding option bets that the rebound versus major peers will extend into year end. And if that happened, well, it's going to probably extend beyond that, and the move is going to be very rapid. So we're seeing people start to bet on that, even though a lot of people are saying, wait a minute, the Fed's going to cut rates. That's going to be dollar bearish. And hang tight. Because right now, overseas developments have been a key driver, with the euro and the yen falling abruptly this month. And as of last week, I told my subscribers in our trading reports, you need to go long the dollar, you need to short the euro. We took positions in that, and right now we're setting up for big gains, and you can too. All you got to do is grab those links in the description below, use a coupon code for your free 30-day trial. Because one of the issues we're facing, even the biggest banks in the U.S. are short the dollar. And that means the longer the strength persists, the more painful it is for the sticking what calls for the greenback to take another leg lower. Among the bears, none other than Goldman Sachs, JP Morgan Chase, and Morgan Stanley. And again, this is going to put not just the banks, but you think about all of their clients that they told, look, short the dollar, this is an easy win. You go short that and you buy anything else and put your hands on it, because that's what's going up and the dollar's going down, and now those trades are going to have to come unwound. And think about this, if the trend, if it continues in the dollar, it could reverberate across the global economy. For example, making it harder for other central banks to ease monetary policy, pushing up the cost of commodities, and increasing the burden of foreign borrowing in the currency. Now for the Fed, this is actually going to be a huge win for them, because we know the Fed wants inflation to come down so they can cut rates. Well, a rising dollar tends to help that. But for other central banks outside the U.S., it's going to be a major problem. But that's not where it stops. A lot of countries, a lot of funds, a lot of people have borrowed in dollars, and right now the repayment on those loans is set to go up. On top of that, we've been talking about the slowdown in the manufacturing sector and how producers are getting squeezed at the margin. Well, right now, commodity price is likely to go higher. That squeeze is only going to get worse. Could put more people all around the world on the unemployment line. And the problem right now is this is only the beginning of the pain that is to come. Because I'm going to show you a very crucial relationship that tells us where the dollar is likely to head. And as you're about to see, it's all about the U.S. labor market. Let's talk about the shutdown, because now the pain ripples through the U.S. economy with no end in sight. We just hit day 10, and the problem is the longer this goes on, the higher the chances we're going to see real people lose their job. I'm not talking about the government employees. I'm talking about all the businesses that rely on their spend. And it's not just about the $15 billion a week in GDP, and now it's going to sting. It's really going to hurt the economy. It's the fear that if this drags on, and right now this appears to be what's going to happen, it's going to have lasting damage on an already weakening economy and a weakening labor market. I want to give you a quick update on our trade on SMH. As tech stocks plunged, well, my subscribers got stopped out for a huge gain. Check this out. We put this trade on back on September 9th. To date, we got stopped out for a 14.66% gain. And my friends, this is exactly how easy it is for you to make money, because I tell you what to buy, I give you risk control levels, and then we update them. All you have to do, pick the trade you want, place them, and then raise your stop loss levels. You don't have to sit in front of your screen and watch it all day. Let your stop losses do the work. Now, to jump in and start trading and making money just like my subscribers, all you have to do, grab those links in the description below, use a coupon code for your free 30-day trial, and stay tuned to the end of the show for more information. And this is why we hear from Waller, who's saying the jobs market is now his biggest concern and payrolls likely turn negative. And this again is a major risk for the Fed, because we talked about how slowdowns in the payroll report will eventually turn negative. And we were close to that inflection point at the last report we had. And I said within a couple of months, that's what we're likely to see. But with the downward revisions, it's highly possible that we would have seen a negative report this month. And again, for the Fed, who would cut rates in this situation, they don't have the data. And this is a big warning from Waller here. He's saying that based on the data from private sources, such as jobs figures from ADP, all they're doing is confirming the picture of a softening labor market, one that if the shutdown persists is only likely to make it worse. Now I want to show you this chart of the federal funds rate versus the unemployment rate, because I want you to see very clearly, as the Fed cuts rates, which you see in blue, you'll notice the unemployment rate continues to rise. And you see that throughout every cycle. And what it's an indication of is that rate cuts don't work. Because again, the problem, as Waller's saying here, is the economy and the labor market is continuing to weaken. We're absent data. But according to Goldman, it is getting worse. As U.S. initial jobless claims rise to 235,000 in Goldman analysis, and then we start to see continued claims. And again, this is the one I'm most worried about. It's a proxy for the number of people receiving benefits, ticked up to 1.92 million in the week ending September 22nd. And again, I've said, if continued claims crack 2 million on the upside, I think it's game over for the U.S. economy. I think we start to see the unwind, because what's happening here in continued claims is it's telling us that the economy isn't creating enough new jobs to absorb all the people that are losing their job. And I've been warning for months that this was the risk in the economy. And sure enough, let's take a look at this chart of initial claims versus continued claims. And what do we see? Continued claims in blue. And when they head up, it pulls initial claims higher. And again, you can see this throughout the cycle. Now, we haven't seen this really happens since about 2022, where it kind of flatlined across initial claims. But again, the risk is that they start to move higher. And again, next thing you know, it's game over. But I want to talk about the relationship between the dollar and the labor market, because this is something a lot of people don't understand. Because I want you to think about this. We're in a debt-based economy, and when that situation, repayment of debt is prioritized. So if there's not enough new money being created in the economy to pay on all the debts, well, then you have a problem, because next thing you know, there's demand for the existing dollars, and that pushes the dollar up in value. I want you to take a look at this chart of nominal dollar versus the average weekly hours of production of non-supervisory employees. As the labor market weakens and you see average weekly hours in red decline, what happens? Again, debt gets prioritized. Now, what's the other issue we're facing right now? Is we have a record amount of debt. And that means it's got to be serviced. So let's go back and look at what happens. As you see average weekly hours decline, what do you see? The dollar in blue, it goes up because people need dollars. You see the same thing happen through 2015 to 16. As the labor market stagnated, what happened? Debt service too high. Next thing you know, dollar goes up in value. You see it happen again in 2018 going into 2020. We see it around 2021, and we're starting to see signs of that now. Now, we already know that demand is declining and projected to further drop due to the holiday season. We're only likely to see about 500,000 jobs created, and that means for those that need work and are looking for work, they're not going to get the hours, they're not going to have the jobs. And again, broadly across the economy, we're likely to see hours drop, and that means we're setting up for a dollar rally to the end of the year. This is what the hedge funds are projecting. But if you tack on one of the biggest short squeezes in history, you can see why the dollar likely to scream higher. So the dollar isn't dead. In fact, it's far from it. And just like a phoenix, it's about to rise from the ashes. And the shutdown, well, it's only compounding the problem in the economy. And we have right now no signs that the shutdown is coming to an end. And with that, we're going to have $15 billion a week of GDP lost. And that's going to continue until this ends. And the longer the shutdown lasts, we're likely to see real jobs lost. Now we also have trillions of dollars bet against a weakening dollar by investors, big banks, people all over the world. And if this thing gets squeezed, it means they're all going to have to buy it back and at a much higher price. And absent the economic data, Wall are saying, look, payrolls, they've already turned negative. And when that happens, it's too late for the economy and very dollar bullish. And all this is setting up for is initial claims to scream higher, catch up with continued claims. And when you look at a record amount of debt, a weakening labor market, too few dollars, the case for a rising dollar is huge. Now, here's what you can do right now. I want you to listen to the Fed speakers because they likely have the best data of anyone. And if they keep talking about a weakening labor market, it's dollar bullish, not bearish. You can also look around the real economy. What's going on with your employer, that of your friends and family? Are everybody talking about how things are getting worse? Are they going to get their hours cut? Again, dollar bullish, not bearish. Now, you may not be directly short the dollar, but you could be indirectly short. Maybe you own tech or gold or crypto. Maybe it's time to take some profits here and hedge your portfolio. You can go long the dollar, short the euro, or even short the yen, and you'll be able to turn this dollar short squeeze into real dollars in your pocket. Now, I want you to see just how easy it is to make money in the markets and how you can do it too. And I've got real proof. Let's take a look at this back test I did on my Metre strategy over the last 2 years on SPY. Now, since I announced this, I've enhanced it, and we're about to make an even bigger update to it. But look at these returns. Total return, 71%, beating buy and hold. Win rate, 66%. That's unheard of on 69 trades. Max drawdown right around 7.5%. And I want you to see this compared to an unoptimized strategy. That's called the Bravo 9. You know, it's run by my buddy Jay Bravo. He says you can't use it on its own, and he's right. You have to use it with a lot of other tools, because the reason is it doesn't work. Look at this total return, 51%. How about this win rate? 51% on half the number of trades and roughly the same drawdown. So what you're seeing here is with the Bravo 9, you're taking the same risk and getting a lot less upside. Now, what is my Metre strategy? Well, it's a professional trading strategy that combines 9 different strategies all into one. Right now it has 10, soon to have 11. And what we've done is we've optimized this for swing trading, meaning we've optimized it for a 10-day hold, putting bigger returns in your pocket much faster than any other strategy, and with a success rate that blows the doors off of anything else. Now, how do you get in on this? Because look, my friends, it's so easy to make money trading. Well, you got to sign up for one of my reports. Now, our flagship report, that's our CTA Timer Pro. We trade against machine positioning. And when it hits big. Now, maybe you like to trade those technical indicators like the RSI or the MACD, and we pair that with a trend. We call that Momentum Timer Pro. Either way you go, you can't go wrong. And what you get is you get all of the trades from those reports. And on top of that, my Metre strategy trades. And even though you get the reports, we give you a notes box with all the details in it. All you have to do is go to the notes box, pick the trades you want, put your stop loss levels on, and then wait for the update. Because you get the daily report, you get all the tradable signals, you get my opinion on the best trades, risk control levels, a full tracking of all open trades and returns, a weekly update. And again, here is the best part of all. Whether you're brand new to trading or you're using it another system and you want to compare mine, we give you 30 days for free. And that's how confident we are. All you have to do, grab those links in the description below. I'm sure to use a coupon code for your free 30-day trial. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.